Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I play an economist on TV. I am joined by the one, the only Anthony Esposito, trader extraordinaire, Wall Street icon. Anthony, how are you doing today?
I play one on TV as well. I'm doing fine, EJ. It's been a phenomenal day. Nothing to see here, as they say. Phenomenal day. Doing great. Doing great. How are you doing?
I am living the dream. Now, unfortunately, it's a bad dream, so I guess I'm living the nightmare. But hey, it's still a dream, you know. It's we're getting by. We're getting by. Better than that we can say for the folks at the Fed. That's for sure. We just got another round of just absolutely horrendous numbers from the central bank, and sure, there's plenty of evidence that these people are just completely botching the job, right, in terms of getting inflation under control. We just had the first month where all of our major inflation indicators actually accelerated, something that hasn't happened for quite some time now. So the idea that we're heading back to 2%, I'm pretty sure we can kiss that goodbye. But the other thing is, the Fed, people don't realize, has actually been losing money. It takes a special amount of incompetence, I think, to have a money printer and to still lose money. But this has been the case going all the way back to September of 2022, I believe, where the Fed is literally paying out more money than they're taking in. It's absolutely extraordinary. It's something that has literally never happened before. At least, Anthony, it hasn't happened for more than 1, maybe 2 weeks at a time in the Fed's history.
This is crazy. So what is behind this losses? So you put a great piece out again, and you've been tracking this, by the way, for over a year out on X and in publication. And you put a piece out just yesterday or the day before that the Fed has now lost, Powell has now lost the same. By the way, the same Powell that has refused to leave office if he's told to leave by the incoming administration, President Trump. We'll see how that goes. Powell has now lost $210 billion starting in 22. What has gone on? What is behind the losses? I don't understand.
Well, essentially, Anthony, the Fed is doing exactly what a lot of banks did. They got on the wrong side of the interest rate trade. And, I blame the Fed here a heck of a lot more than I can blame places like Silicon Valley Bank. Now, they screwed up in their own ways. For example, they had inflation rate hedges that they proceeded to sell when they were at the peak of their value. So, okay, we can fault them for that. But they also believed the Fed when the Fed told them, we're not going to raise rates and we're not going to do it for several years. It was literally only a few months later, after making that promise, that Powell embarked on the beginning of that rate hike, that rate hike series, which included the fastest hikes in 40 years. Mm-hmm. So basically, banks, knowing, or they thought they knew, that they weren't going to have higher interest rates in the future, loaded themselves up with assets that were at very low interest rates. So they basically issued a ton of mortgages, right? 30-year debt obligations, essentially, at 2 or 3% interest rates, never thinking that in only a year and a half, they were going to be paying 5% on deposits. But that's exactly what happened. So you can imagine, all right, if the asset side of your ledger is at 2 or 3% and the liability side is at 5%, that's a quick path to insolvency. So that's what a lot of these banks did. The Fed has essentially done exactly the same thing. And people forget that in March of 2020, obviously because of everything else that was going on in the world, the Fed got rid of its interest on excess reserve policy, something that was started under Bernanke, a way to try to get banks to park more money at the Fed than they were legally required to. And what they decided to do was to simply go to interest on any reserves. It was incredibly stupid, but it's what they did. And when interest rates were near zero, the expense was near zero as well, because you can have those balances as high as you want, those reserve balances, when you're paying not even 1/4 of a percentage point interest. It's nothing. The problem was that as those reserve balances marched up, so did interest rates. And all of a sudden, the Fed was paying 5%. On top of that, because they printed so much money, they were having to soak up excess liquidity to try to maintain an interest rate floor effectively. So in other words, they printed all this money for the Treasury to spend. The Treasury spent it, but now they had to get that money back out of circulation in order to try to keep a lid on inflation and to try to keep interest rates up. And they did that through something called the reverse repurchase agreement facility. So the Fed was essentially paying all of this interest on these different accounts, again, at over 5%. Meanwhile, they had loaded themselves up during the pandemic with a bunch of government bonds and notes paying like 2%. So again, quick path to insolvency, just like the banks experienced. And this, by the way, is directly costing taxpayers. The reason for that is whenever the Fed earns a profit, they actually hand it over to the Treasury. It's called remittances. When they don't have any remittances, when that goes negative, they call it a deferred asset. Yes, that's right. When you're the Fed, a loss becomes an asset. It goes on the books as an asset, and it's money that they will earn in the future, but not have to pay the Treasury. So, as you said, Anthony, they're 210 billion in the hole. So once the Fed actually starts earning a profit, they have to earn 210 billion in profit, and that will simply cancel out that quote unquote deferred asset before they start sending any money to the Treasury. So basically, instead of sending profits to the Treasury, the Fed sent them to Wall Street instead, sent it to the big banks.
Yep. Yep. So in my world, that's called a watermark, and that is a damn high watermark for the Fed to get to start to become profitable again. That's the point where you shut down the business, you go to the Cayman Islands for a month or two, and then you come back and you try and get some new investors to take a shot on you. That's absolutely absurd. And it sounds like, it is, right? That's like losing poker. That's like being the dealer holding all the cards and losing as far as the Fed goes. Like they literally were controlling interest rates at that point in Fed policy, and they still made the wrong decision as far as assets and the amount of assets they would take in and what those assets were paying in interest versus what they were going to owe out. Is that a fair poker analogy that they were holding all the cards and they still lost?
That's spot on. In fact, I'm going to steal that if you don't mind. That's exactly what they did. And one of the really crazy things too, Anthony, is the fact that this is kind of a case of the right hand not knowing what the left hand is doing, because, and this speaks to how much they screwed up, I think, as they're having to pay all of this interest, and it's more than the money they're taking in. That means the Fed is effectively creating money. There is more money leaving the Fed than coming in. And so at the same time, they're trying to sell off the balance sheet, or roll off the balance sheet, I should say. They're trying to decrease the amount of money out there. They're also sending all these interest payments out, increasing the amount of money out there. So they've effectively been conducting quantitative easing at the same time they're trying to do quantitative tightening. And one of the scary things is when we look forward to the Trump administration, is the fact that once the Fed actually gets a handle on this, which there's a decent chance they're going to be able to do that over the course of the next year, they're now going to stop that stealth quantitative easing, you might call it, and then it'll just be full-fledged quantitative tightening, but you're going to be getting it with both barrels, because at the same time that deferred asset is going away, which again represents a form of quantitative tightening, they're going to continue rolling off the balance sheet, more quantitative tightening. So you are going to see some big restrictions in monetary growth, and that'll help tamper down inflation, but it's going to make it very, very difficult for President Trump.
Interesting. Okay. So as we talk about those things, we head into the end of the year. I wanted to kind of pull this into this policy. And honestly, the complete mishandling of the Fed, you have a great grip on policy, what works, what doesn't, and what the effect of the policies are between the Fed and the Treasury. It's okay if you steal one or two things from me over the course of a year, because I steal a ton of stuff from you every day. So that's, I'm just saying.
Mutual theft.
What's it's called sharing.
Sharing.
We look at the market, and there are some headwinds, and these are headwinds as we're talking about, credit tightening, losses at the Fed, losses at the banks, what interest rates look like they're going to do, what inflation looks like it's going to do. But I wanted to pull up two charts and kind of give a broad stroke of where we are as far as equity markets now as we roll into December, which is amazing that we're going to be at year end soon. The first chart is a monthly chart of the S&P. It's not the S&P total return, it's the S&P index. So this is the chart of just price action for the SPX index. We can pull that up and take a look at what it looks like over time. So we pull that. I have it back to 1992. This chart is the monthly, as I said, of the S&P. And you can see from 2000 to 2013. So for 13 years, the S&P consolidated probably a little longer than that, the way I drew the chart, but consolidated between 1550 and 650, right? So low, obviously much lower end of the range where we were, a 900-point consolidation. Within there, we have the tech bubble, which is the beginning of the consolidation. We have the credit crisis, the housing crisis, 2008, 2009. And then we have a breakout in 2013. But you can see how the breakout occurred as we started to look at and we started to deal with really loose money, really dovish Fed, and liquidity being pumped into the market, right? So from 2013, from the low in 2009 to the high, our recent high this week, the index has run 800%. And it's been almost hyperbolic on the way out of that consolidation. I mean, certainly on a measured move, that 900-point consolidation should have taken us up to 2,500, 3,000 would have been a good level to start to consolidate, grind higher, and move in a more natural way. But we've been on steroids. We have the 2020 dip there because of COVID. We have the recent dip down there as we move out in 2022. 2018, we have the trade war scare between President Trump and his first term in China. But the move has really been by the dips all the way. The move has really been fed by an increasing monetary base, lower rates, loose money, and just an injection of steroids into the stock market and the risk taking. Risk taking has exploded. Now, if you look at momentum, which is the bottom portion of the chart, that's the MACD, and that's what I'm using here to track momentum. Momentum's healthy. Momentum is expanding on the monthly. We're continuing to grind higher. We're staying above that 10-month moving average consistently. It is a positive chart, but I would say that there are some headwinds coming our way. One would be interest rates, because we see that the market's not ready for lower rates, even though the Fed is cutting rates. We've talked about that with the 30-year. We've talked about that with the 10-year yield. Rates are headed higher or holding higher. Rates have come out of a massive secular bear market and are now in a new secular bull market. So that remains to be seen. And we've gone through inflation where we're seeing, as you said, recently an uptick in PCE, core PCE. The inflation numbers are closer to 3% versus the Fed's target of 2% as they're cutting rates. So we're not in a position where inflation is truly under control, and we're not in a position where rates are going to be friendly for the market. Trump is definitely walking into, and we've said this before too, Trump is walking into kind of a ticking time bomb, and it's going to be some real maneuvering for him to kind of move through and not see a massive recession, not see a massive spike in inflation, and to keep the markets kind of steady. But full circle, the markets right now, out of a massive consolidation, 13-year consolidation, are up 800% off of the 2009 lows. Momentum is strong. Sentiment is strong. There is a massive long exposure in the market. People are levered. People are over-levered. Margin profits on the banking side, meaning what the institutional clients are paying for loans to buy more stock, are at all-time highs, so on and so forth. I believe we're late stage, but there could be some more upside. Momentum is a funny thing. It's really, it's very, it doesn't break easily. It gets very stubborn, but when it breaks hard. And that's when people are going to turn around and go, wow, I didn't see that coming. So I think there might be some more upside just because of the momentum we see in the investment in the market. But there are some real headwinds people are not talking about. And I would be very careful as we look at this chart, this hyperbolic chart. We're getting towards a point where we need to retrace to the downside quite a bit here. If we look at the next chart, that chart, I thought it was interesting to look at PEs, which I normally don't talk about because it's kind of off the track of my technical path. But, we are at a 27 PE on the S&P reported, which is relatively high. I mean, to consider that, and you can look at Goldman Sachs's recent comment that next 10 years out, we're going to be looking at 3% annualized returns versus 10% annualized returns, which we've seen over the past 10 years. So definitely a tampering down of expectations of returns from the market. And that's directly related to, the price to earnings ratio. How how inexpensive are stocks or how expensive are stocks. And historically speaking, stocks are very expensive here. I mean, we're 2 standard deviations away from the mean at 27. We're higher end of the range at 27. We would want to see this PE down at 16 or 12 before we could start to say that we've washed out and stocks are actually cheap. So this PE chart shows exactly another headwind that could be hitting stocks fundamentally. Talk about rates, talk about inflation risk. There's definitely some headwinds, but there's a lot of momentum behind the equities markets, and that could push us a little higher, in particular as we get through December, which is typically a flat to up month. November, the strongest month seasonally of the year, which most people don't realize it is actually November. Everyone talks about the Santa Claus rally in December and some stronger months throughout the year, but November is typically the strongest month, and we saw up 6% in the S&P in November. The Trump bump was a big part of that, but we're seeing good momentum and we're seeing good strength, but we are extended. Price to equity, PE, price to earnings are extended. Momentum is strong, but we're somewhat extended. Margins are extended. Leverage is extended. It's time to be a little cautious with the market where we are giving up another, 5 to 10% to the upside to not get nicked for 40, 50, 60% to the downside is probably a prudent way to think about this at this point.
So, Anthony, if we start anticipating a pullback here, right? What does that look like practically speaking? In other words, like action items here. Are we thinking about things like outright shorting? Are we thinking about moving into cash? Are we thinking about fixed income? Or are we thinking about some alternatives?
Yeah, I can tell you right now. I can tell you exactly what I'm doing at Island Capital. We have moved from a group of longs, and we trade top-down sectors in S&P and the Russell. We've moved from those longs. We've pared down there. We have kind of fan favorite positions that I think are just they're longer term holds, and I'm holding on to those. But I am preparing. Somebody asked me today, "Are you trading? Are you active through the month?" I said, "I'm not trading, but I'm positioning." And I mean that exactly the way it sounds. I'm positioning for the first quarter of the year. And part of what I'm looking at is the small caps, the Russell as a short. I'm trying to find inexpensive puts that I can buy at least out to March. I want to get through President Trump taking office. I want to get through earnings releases as we head through the first quarter of next year. So for the tail end of 24. And that's where I stand. So outright shorts, definitely, but you have to be careful there depending on your appetite for risk and your appetite for if you can stomach some paper losses along the way. The outright short eats up more capital, and it's more dangerous as far as P&L goes. Shorting for sure, strategically. I'm looking for cheap puts on the way out, and I'm actually focusing right now on the small caps. They caught up in the past few months. They were basically flat to negative for the year, and in the past few months have caught up or up 20% on the year here. They are overextended. They are at an all-time high, and they're butting their head at resistance now, and momentum is actually divergent. So for me, as I look at that, I look at them as at risk. 50% of the Russell is non-profitable, and they are extremely sensitive to interest rates. So if interest rates are going to push higher, persistently higher, and we're not going to get those cuts we're talking about, if inflation is going to reignite and push higher, those small cap companies are going to get hurt and will lead the way down as they always do. They will get hurt more so and more dramatically than the large caps that can handle that type of situation. So for me, I'm looking for strategic shorts, top-down shorts. I'm not picking out companies right now. I am generally top-down, and I am top-down here getting short Russell. I'm starting to look at the S&P. There are certain levels where the S&P breaks that I would be short or buying puts there or shorting the futures, but definitely want to be exposed to the short side in the equities markets and in particular here, the small caps. As far as gold goes, I'm still long gold. We traded around the recent dip down and the recent move. I do believe that gold still has 3,000 in its future. That position has been pared down as I traded around it, but I am long gold, and I do think that gold has the potential to hit 3,000. I'm sticking to that, and a lot of that has to do with the inflation story. I don't think we're done needing that inflation hedge, and gold will benefit from that.
And tying into that inflation story, I mean, we basically didn't see any change in the data from the previous Fed meeting, or excuse me, I should say the one before the previous one, the penultimate one, I guess, to the most recent Fed meeting. And yet, what was really interesting when we went through those minutes from that meeting, all of a sudden the members of the board took like a totally different tone in terms of interest rate cuts. And this ties in, I think, with what you were saying about how some of those companies are going to be much more interest rate sensitive than others. It is painfully obvious that after the Fed, got the results of the election, all of a sudden they radically changed their tune in terms of how many cuts they were anticipating, how big those cuts were going to be, et cetera. And now all of a sudden that it's not President Kamala, that it's going to be President Trump. Again, they're singing a very different tune, and it sounds a lot more like higher for longer as opposed to, cut hard and fast, and we'll worry about what we break sometime in the future. So I'm really glad you have your eye, like you said, on those companies that are going to be a little bit more interest rate sensitive. I think that's a really powerful insight.
Yeah. Thank you. I mean, I think that's the play here. And I think that the cards are laid on the table. It just depends on whether you want to pay attention to them or not. If we're going to be implicit as investors and as a market and believe what we're seeing on the screen without questioning it or really digging in, then that's fine. And honestly, it'll work a lot of the time, right? The market goes up 86% of the time if you clock it. So you'll be fine. You may underperform, outperform the index, but if you're buying those momentum names and you're kind of just going along to get along, you'll be in pretty good shape for the most part until you're not. And that's where paying attention to the tea leaves, looking at what's on the table, and not just blindly going along with what the market is supposed to be showing you or what we're supposed to believe the market's saying, but actually questioning the market. Tudor Jones actually was out yesterday, which was, I think he put it in a great way, talking about Kayfabe, which I never heard of before, but how there's an understanding between professional wrestlers and the audience that this is fake. It's fake, but let's all make believe it's real. And I kind of feel like we're getting to that spot in the market, which was his point as well. And I would agree with that. I mean, I think the headwinds that we're not talking about are massive, and they're building, and they'll continue to build into the first quarter and second quarter of next year. The recognition of those headwinds will be dramatic. And then as we enter the fear stage, where everyone's afraid of giving back the profits and the P&L that they've earned over the past year, 2 years, 3 years, that's where you see those massive drawdowns ending in finally capitulation stage 3, where everyone's like, I don't care what the price is. I don't care what you need to do. Get it off my sheet. I don't want to see it anymore. And that's where you see those, March 2009 lows where everyone is, get it out. I don't want to see it. I don't care. And that's kind of where we are. I think we're making believe that this market is a lot stronger and has a lot, more of a base than it does. And
there's a term that I'd never heard of called Kayfabe. And in wrestling parlance, that represents the unspoken, unwritten, tacit agreement between the wrestlers and the fans about the illusion that's going on in the ring, the suspension of disbelief that what's going on in the ring is actually, we know it's scripted and we know it's a performance, but they ask us to think it's genuine and real.
And so that's what you think this is?
Yeah, we're in an economic Kayfabe right now. And it's not just the United States. We're in it in the UK, in France, Greece, Italy, Japan being the biggest of all. It's this economic Kayfabe. And the question is after this election, will we have a Minsky moment here in the United States and U.S. debt markets? Will we have a Minsky moment where all of a sudden there's a point of recognition that what's going to happen or what they're talking about is actually fiscally impossible, financially impossible?
So are you betting on a Minsky moment?
I am clearly not going to own any fixed income, and I'm going to be short the back end of fixed income because it's just completely the wrong price.
So first of all, Andrew Larkin-Sarkin is one of my favorite financial commentators out there. He could not be more left-wing and more biased. I mean, honestly, he deserves a bonus every Christmas for being the most liberal left-wing biased commentator on the air. What I would say about the Minsky moment, and that's interesting, and I'm actually going to lean on you here for the Minsky moment, but as we look at the Minsky curve, and correct me if I'm wrong, because I could definitely be wrong here, we look at a yield curve flattening and then inverting, and then to Jones's point, very quickly and aggressively reestablishing itself at a very steep yield curve, meaning the far end of the curve, those bonds will get crushed in price, spiking up yields much higher than the short end. Is that kind of where we're at? And does that make sense to you as far as this Minsky moment?
I think it does make a lot of sense, and you're 100% right, Anthony. One of the things I've heard this idea thrown around by a few people, including Judy Shelton, Scott Bessent. One way that will address some of our fiscal problems and I think help avoid that Minsky moment would be we need to address essentially the confidence that investors have or lack thereof in long-term U.S. debt securities. Mm-hmm. And one idea is, what if we do a 50-year bond, which at first you may say, that sounds terrible. It's exactly the opposite. I want my money tied up for less time, not more time with the U.S. government. But what if we do a 50-year bond that effectively has a kind of call option on gold? Mm-hmm. So that you can, yes, sure, you can take $3,000 at maturity, or we'll give you an ounce of gold, and you, as the holder of the bond, get to pick what you want. So now all of a sudden, you know that the government can't simply inflate away the value of that security, or I should say of the debt obligation, because if they're just going to pay you back worthless dollars, worthless pieces of paper, then you get to pick the gold. And there's different variations of this. Like maybe you don't have to take delivery of the physical gold. Maybe you just get your dollars adjusted for the price of gold. So if gold doubles to $6,000 an ounce from $3,000, then that's what you get at maturity, $6,000 instead of $3,000. So there's lots of different ways you can do that, but one way or another, the idea is you're going to peg these very long-term securities to gold. And now all of a sudden you have a debt instrument that you can use intergenerationally, right? From kid to grandkid, or just from an older investor to a younger investor. And you can do that with confidence, again, because you're tying it to an asset that you can't simply just print away. Now, absent any kind of reform, I think the transformations in the yield curve that you just articulated are exactly what you'll see, and it's going to have pretty devastating consequences.
Yeah. So that's really interesting, and I think you touched on this last week as well. Almost creates like an inflation-protected 50-year bond, right? Mm-hmm, mm-hmm. That's interesting. And as far as the we need to increase confidence in buying the debt, we've lost our incremental buyers of U.S. debt, but as we continue to issue more debt, right? So we are actually, again, correct me if I'm wrong, but we're actually we are the number one buyer of our own debt at this point now that China has stepped away. Is that correct?
Yeah, Anthony, you're spot on. So China is rolling off U.S. debt. In fact, they're not just rolling off, but they're actively selling some of their holdings. Russia already sold off everything before they invaded the Ukraine. That was probably part of the calculus there. So if you look at most countries around the world, they're net sellers. The Fed today is a net seller. And this is a key reason why we've seen yields march higher, despite the Fed actually cutting rates the last couple of meetings.
Yeah. Yeah, so full circle back to this is a story people are not talking about, or if they're thinking about it, they're not thinking about it out loud. And I think it could end up being one of those things we look back at, as there were many in the past, 2-3 cycles where we were at peak, and then we look back and we're like, oh yeah, probably should have seen that and been talking about that, but we weren't. And I think this might be one of those things. So, heading into the end of the year, I like gold. I like my core holdings, and I like being short, starting to get short and build that short for the first quarter in the small caps. And I'm watching the S&P because the S&P will crater as well. But don't want to be too early there. There's an old saying: the markets can stay strong much longer than you can stay solvent. So to be short, and to be short in the wrong size, and the wrong time is just, you're shooting yourself in the foot. But I think it's time to start thinking about these things for real. I love the 50-year bond, EJ. Thank you for bringing that up again. It's really those are the things, right? Those are the things that people don't know about, that I don't even know about, that, they're in your hip pocket and you pull them out and throw them on the table. And it's a real education. So thank you very much, my friend. Appreciate the time, and have a great week. And I will talk to you next week.
Till then, Anthony, always a pleasure.
Thank you.